Hello, my name is Steve Bigelow with the Candlestick Forum. The market direction did not change on Friday, even though it had the potential to. As we saw, we were looking on a positive trade, and notice the candle on Thursday was not quite a reversal signal. It wasn't quite a halfway up this candle, so it wasn't a piercing signal, and you wouldn't consider it a hammer signal because the tail was not 2 times greater than the body, but it gave implications that there might be a bounce. And where would we think the first bounce was heading for? The T-line. The NASDAQ opened positive. But what were we still having to utilize as our overall analysis? We hadn't closed above the T-line. And remember our very simple trading strategy using the T-line. Until you see a candlestick buy signal and a close above the T-line, it's implied you're still in a downtrend. So we can use that information for day trading if you're day trading the indexes. Because where was the first logical bounce area to? The T-line, which it did early on Friday. So our perspective is, look what was happening when it was up there testing the T-line. A bunch of dojis, which told you there wasn't a lot of force trying to go through. There's a lot of indecision up here. And that was, again, correlated with the Dow daily. It was kind of nudging the T-line, but not going through. So what did this tell us? That now that they were up at the daily T-line, the 10-minute chart was saying it's starting to sell off. If you had been trading the YMs, you would have closed them out and reverse going short. Because now what would be the trading strategy? You could stay short until you see a candlestick buy signal and a close above the T-line, which in this case allowed for a good, strong bearish trade in the Dow. Same scenario with the S&P 500. Where was the bounce likely to go to on Friday? Right up to the T-line. Now remember, this is not magic. The T-line acts like a natural support and resistance level of human nature. So the fact that it comes right up to that level and doesn't go through is telling you the aspects of a T-line is that it's going to act as resistance until they can close above that level. Knowing that, same scenario. Look what the S&P E-mini chart was telling you. The 10-minute chart was telling you there's lots of indecision. They weren't going through. And when they closed back below this level, if you're trading the E-minis, what's your next strategy? You would have closed out and gone the other way again, looking for coming back up through the T-line to cover a short trade. In this case, it didn't happen. So the overall scenario was, as long as we were still trading below the T-line on the indexes, you had to assume there wasn't an uptrend yet. Be a little bit more cautious that the bears are still in control, which was evident on Friday. Now, this allows us to take advantage of high profit, high powered reversal signals. The slow curve. You can see how it was slow curve and what was evidence of lack of buying pressure. You're still trading below the T-line. This is our expectation of a slow curve result, which you saw in here on Friday. Same situation here. Look at all the evidence that this slow curve was not producing any bullish sentiment, and the expectation of a slow curve is a strong move, which in this case, you could actually kind of anticipate what would be the next target. Obviously, the 50-day moving average. And our recommendation on AMLX to short was on the basis that you had a slow curve, a bearish stick sandwich, you were probably heading in a downtrend. So the rhetorical question always is, do we expect a big move like this? Or do we anticipate a big move like this? Not all the time, but we know that we're putting ourselves in situations where the probabilities of the results of this type of pattern is that big price move. So utilizing the information built into candlestick signals tell us where the strongest bullish or bearish reversals are occurring. Our recommendation a few weeks ago on EEFT was based upon that doji gap down, your bearish best friend, staying below the T line, failing at the 50. What's our trading strategy at this point? No anxiety. You just stay short until you see a candlestick reversal signal and a close above the T line. Identifying the strongest signals are what's going to put you not only in a correct direction, but the magnitude of that direction is going to be relatively strong. We recommended AGIO because of its bearish or this bullish best friend signal. Best friend signal with a doji right off the 34, gap up through the T line, gap up through the 200, broke out through this level. What'd that indicate to us? There was a new investor sentiment. And notice what the confirmation of that bullish sentiment was. They were trading positive on a day when the markets were selling off hard. So remember, the signals are going to be the top criteria for what is going on in investor sentiment. Everything else is just a confirming indicator. So take advantage of this. We're going to be doing a mini spotlight training Saturday. They usually are supposed to last for an hour, but they usually go on for 2 hours. But the information you get out of one of these is just what strengthens your ability to see what candlestick charts look like to show you the strongest trades that are going to move in the right direction. That'll be it. We'll see you in the chat rooms.